Hi, everyone. It was an extremely impressive, I'd say, session in the market today. The end of day action in the Dow Jones Industrial Average and S&P 500 from the flat trading range that it saw going into the final 30 minutes of the day was quite impressive on a breakout overall effort, and that will on that note, we'll go ahead and go to the S&P 500. And as you can see, there's more new highs on below average volume. It's weird, and it could just be all short covering here. And it might now just be getting a little, just starting. Who knows? Maybe this uptrend is just starting, and maybe we're about ready to go super parabolic, like in the 90s. That would be quite something, but you never know. But as of right now, everything's firing on all cylinders. The only thing that's missing is volume, but it doesn't matter. However, I want you to notice something which is quite irrelevant overall to my trading, and it's very third-area indicators. All these lines you see all over this price chart really is noise. I only pay attention to these in the middle, volume, and this, price action. Price and volume is all that matters. However, all these lines give me an overall quick synopsis in my brain after 15 plus years of the overall strength underneath. Does it really matter at all my trading? No. But one thing that I've always noticed is that whenever green bop, that's these bars here, start showing up in the indexes after longed uptrend, it's normally, I'm not sure why, but price volume wise, it normally means that we normally see a pullback. And when we see the New York Stock Exchange, S&P 500, the NASDAQ, and the Russell 2000, I really start to get short term a little scratchy headed. If we pull back here, I'm not going to be surprised if we pull back to the 50-day moving average, and even a big pullback 200-day moving average would be amazing and allow hopefully for some basis to build for another re-entry into another leg of this bull market, because as long as quantitative easing continues, I don't see how this is going to stop. But overall, as you can see by looking at everything, we are on full go, and there is nothing to do until we probably find resistance at 5,132 on the NASDAQ. But in every other index, it's clear skies ahead. Everybody, as of today's close, is profitable except for those shorting the market. But any long over the past 20, 25, 100 years, if they're long the market, they're making money. And on that end, if you're not long the market, watch closely the biotechs. The biotech group is the leading group. This is the IBB. You see the XBI today. It's just very bullish overall. And look, it has so many stocks. You got Celgene at 127, REGN a 273 stock, Amgen a $106 stock, ALXN $104 stock, BIIB 213, ONXX 97, ILMN 69, VRTX 80. All of these are extremely high quality, huge earnings and sales growth. So if you're still under invested in this market, watch ALXN for a breakout, to new highs. That would be, for instance, something that I would do here if I need to get a lot long. Celge's breaking out to a new high. This isn't a breakout I would buy, but it's pretty safe to say that with the group moving, it's pretty a low risk trade. AMGN, that's a nice move out 200-day moving average. I know you don't have a pocket pivot point buy signal, but still, that's a low risk entry area. BIIB, I wouldn't touch that one just yet. ONXX, let that base out some more and a breakout easily. It's a long. ILMN needs to calm down a bit, but as you can see, the buyable gap up so far has worked brilliantly with this leading biotech stock. And VRTX, following its amazing gap up on huge volume, has pulled back and now is starting to move higher again on above average volume. It's still too early to me, and this is what a daily chart looks like on the arithmetic. So as you can see, it's just now beginning a right side of a base. So I would let that play out a bit more before going long. But, that's the sector I would watch. And if you really need to get long here, because at the same time, while you really might want to get long, it isn't completely safe. You saw LinkedIn, DGI today. You saw Zillow and Cooper Tire. You saw Solar Fund, or SoFund, excuse me, Holdings. You saw an ITC, another heavy, highly priced stock, excuse me, that's failing a nice basing pattern right at the 50-day moving average. And then SIRO, another breakout fake out in a high price stock. So it's not all smooth sailing up there. And on that note, we have some sells, only 3 though. minor sells. INSM is closing below the 20-day moving average, as you can see here. That's always an automatic 25% sell, so there you go. That is that. VIPS is closing below the 10-day moving average on heavy volume, but why am I selling this and not waiting for the 20-day moving average? Because there's still a 20% gain. I would hate to see a 20% gain in a relatively decent sized position go to complete waste. But the uptrend, you know, it was really smooth early on, got a little rough as it started to become a higher price, and following this breakout here, it's really starting to pull back a bit much. Now, the relative strength line is extremely strong in the stock overall. Once again, these lines that I like to follow. But the price action on a day like today is just a little too negative for me, with the markets up almost, 0.5 to 1%. This stock down 6% on very strong volume. And I believe earnings are coming up. So earnings, I think, are on the 17th, if memory serves me correct. So I'm getting a little worried. If BOP was still green on this pullback and we had that heavy volume intraday reversal, I wouldn't be as worried. But since BOP went negative again, like it did in April, this time doing it with volume and with a little bit more of arrogant price move to the downside, I would go ahead and be a seller here. But instead of 25%, it's only going to be 20%. Going to use 20-day moving average as possible support. Closes below that, another 25% sell. Hopefully, though, we can get a gap up on this stock and continue to work on the initial gains. It's unfortunate that such a nice stock, after producing the signal back here, if you remember, isn't quite producing the huge gains that we would expect to see. If this base was longer from this part in February 22nd to, or actually it's going to probably be the 23rd because of this day right there, 25th, of course, Friday. So if the base from the 25th of February was longer than when this move occurred in March, it would probably be a much more smoother uptrend. But overall, as it is, more distribution days showing up than accumulation days. That's why it's 20% sell. And also PERI, it's still above the low a day of the signal date. The signal date, I already told you whenever we went long this ad that it was a very risky trade, that it wouldn't surprise me if, we're going to suffer some harsh pullbacks. I didn't know it would gap up so far from 1298 to 1333. So by doing that, that automatically made the low a day of the execution date, 1294, a cut loss area, and then the final cut loss at 1219, thanks to the gap. Well, with 1294 being the first cut loss area, a close below 1294, and since 1260, there you go. So we got to get out of half of the position, but I'll go ahead and let 1219 work as the other half. Now, longs that I'm passing on tonight, well, they're not really longs, but severely interested and wanted to take LOCK. If LOCK would have closed at 1008 or 1009, it's a new long position tonight, with BOP increasing from the day before, a very big volume surge. However, with the extremely strong close at the end of the day today, but yet the stock doesn't close near the high day today, that's short-term negative divergence, and I want to see the right side be worked out just a little bit more, because as you can see, it's still deep in this consolidation pattern. Also, UEIC, nice breakout, going to pass on it. It's a bit thin for me for such a short cup with handle breakout. If the cup with handle was much larger, and EIC had a longer handle and closed more in high day, then maybe we'd be talking. But the sales, earnings, and overall volume isn't impressive enough. And then ALXN, I already showed you. You could use it as a second day pocket pivot point signal. I showed ALXN and the stocks to watch yesterday, and it's following through today. So that's definitely an interesting one. We're going to add to DDD today. DDD produced a pocket pivot point buy signal. That's its third one since hitting lows in its lows in March. It's produced one successful one, a second successful one, and now it's producing hopefully what will be a third successful one. If it doesn't work, what I'm going to be using as the first cut loss area is going to be a close below the 10-day moving average. By the time Monday trades, the 10-day moving average will probably move up to right around the mid-range of the bar from 510, i.e. today, as of today's video. And then the final cut loss is a close below 43.85. And the only new long, and by the way, that's going to be a 2% and 2% position. Once again, that will get us up to 6% long DDD in both accounts. And if DDD wasn't so sloppy, this could easily be a 10 percenter by this point with its earnings and sales growth and overall accumulation the past 3 days. And as you can see here, the past 3 days on this chart, I mean, this is just astronomical volume compared to what it used to trade. The only new long is Take-Two Interactive, and it's going to be 2% and 1%. Why 1% only one account? Because earnings are going to be on Monday. The stock gapped up the last time it had earnings in February, and it produced some big numbers. And as you can see, estimates are pretty large for Take-Two Interactive, and sales are expected to increase 90%. As sales increase over 90%, and we have another 100% earnings per share gain, that's going to be an amazing 3 quarters. And then look at 2014's earnings per share estimates. You can see mutual fund growth is starting to go in the right direction the last 2 quarters. So hopefully, or in the last quarter, excuse me. So with that upcoming earnings estimates, the current earnings per share and sales growth, and with the earnings supposed to come in over 100% and sales over 90%, I think this makes a good lead in. A straddle position, buying calls and puts at the same strike price, or a strangle, which is a price like surrounding 16, like a 17 and 15 put and call, would be a way to play the earnings if you think it's going to gap a lot. I'm just going to stick to the regular shares. Okay, everyone, have a wonderful weekend. I'll see you on Monday.